Good afternoon, good evening, and good morning to all my friends and viewer. Welcome to my live stream in YT. Uh, Today, my topic is all about money, credit, and banking. My topic is investment and international finance. So, in investment and international finance, they are number one, introduction to investments. Number two, the role of IMF in international finance. Three, exchange rates policy of the DLDC. Four, the social responsibility of financial management. Now, let's go to first topic, introduction to investment. Everybody wants economic security. In fact, this is the primary dreams of the poor. In the case of the more fortunate of the poor, In the case of the more fortunate ones, their idea of economic security has higher level. They aspire for money, lands, and properties that they invest in large-scale business to acquire more profit. However, no investment is risk-free. Investment with minimal risk usually earn less profit than those with greater risk. In any case, an investor should be careful and selective in his business venture. He should not only consider the stability of the value of his investment, but also its earning power. Thus, those wanting big profits invest in risky ventures. In the real sense of big profits investment. These kinds of individual are not investor but speculator. Still, there are those who place their money merely on impulse or reckless decision on activities hoping for large return. They are professional gamblers. It is a win or lose situation. Now, let's continue. This chapter provides an introductory information on the nature of investments, including risk and classes. Well, in how to plan futures are discussed. The nature of investments. In general, investments refer to an asset or property right acquired profit motive. Such definition does not make any distinction whether the investment is safe or risky, tangible or intangible. Welcome po. Thank you po for sa thumbs up. Directly owned or those managed by institution. Magandang hapon po, Ma'am Iram. Gamit ko lang po ay hindi po ako nag-StreamYard. YouTube lang yung gamit ko. Now let's continue. Moreover, such definition is not only within those which earn cash income, but only confined within those which satisfaction. However, in a narrow sense, the word investment suggests a minimum risk of loss, meaning investments offer dependable income, relatively stable value, and a modest rate of income. Those who expect big profits are therefore not investor. Thank you po, Madam Ira Morales Vlog. Welcome to my channel, to my live stream. Welcome po. They are known as speculators. Clearly, speculation assumes a greater risk than investment. This is the difference between speculation and investment. Business venture which have a higher degree of risk command of more profits. Such feature lures the, not a few into engage in speculative transaction. Meron na po, ayan, bigyan ko na po kayo ng blue. Nevertheless, they are individuals who speculate on the basis of tips, rumors, or engage in situations which they do not understand. They are not really speculators but actually are gamblers. Such reckless risk taking is not the nature of investment. There is safe and sound planning and decision making in investment. Risk of investment. There are fluctuations in economic activities which have been influenced by political and economic factors. Naturally, the value and earning of an investment is affected either favorably or unfavorably. For instance, during inflation, the income from an investment is reduced. In terms of purchasing power, other factors like taxes, technology, taste and preference, peace and order attitudes, and interest rates, among other things, affects profitability of investment. Wise and prudent investor can identify the impact of such factor on investment, thus they are able to make the right decision for the investment. There are four distinct types of risks of investment. Such risks vary among different classes of investment. Some of these risks are minimal in certain investment, while intense in other investment. Number one, business risk. This is the first and greatest risk. All business and properties are subject to unfavorable possibilities like decline in their usefulness or earning power. This can happen due to the business competition, change in demand, error made by fluctuation in market prices, which are the result of free greater than supply price increases than those with lesser demand. The demand for certain types of investment depends on the incomes and preference of investor. The fall in the value of investment means loss, unless its previous earnings are sufficient to compensate for loss in value. In of bank saving deposits, their interest incomes are affected by market risk based on the law and demand. When the supply of money is greater than the demand for money, the price of money, interest rates falls. 3. Inflation risk. The value of purchasing power of an investment declines whenever there is inflation. This is a situation in which there is a general increases in the level of prices. There are several causes of such as the shortage of supply, excessive money. Yes, welcome po, Ma'am Iran. Welcome po, Madam Nene. Thank you for coming to my live stream. Welcome po. Yan, nilagyan ko po kayo ng blue, ng jacket. Okay, I will continue my topic. Supply as cost of production and desires of capitalists for more profits. As an example of inflation risk, Land Bank bonds issue in 1970 at 6% interest have greatly depreciated in value at the present time. The value of 1 peso 20 years ago could no longer purchase the same number of goods and services at present. Thank you for the thumbs up. Thank you po. Thank you for 2 million watching. Number 4, social risk. Such hazard is brought about by government laws and policy. In the name of social justice or economic welfare program, the government controls profit and prices. Evidently, this reduces the earnings of investor. In other instances, the government buys private properties like lands and at lands at a low price. This has adverse effects on the value of the lands. Social risk is basically political in nature. It depends on the value or inclination of politicians to promote the welfare of their constituents or to get more votes. They make law favorable to consumer but not to investor. Classes of investment. Number 1, savings deposit. These are savings deposit in banks which are considered safe investment, especially if these are placed in large commercial banks with an excellent reputation. Bank deposit are covered by insurance up to 40,000 pesos. Number 2, time deposit. These are also bank deposits within the various days maturities such as 30, 60, 90, 360 or more days. They earn higher interest than savings deposits. Likewise, time deposits are covered by insurance up to 40,000 pesos. 3, life insurance policy. These constitute both insurance protection and saving account. Although these are safe investment, their values can be eroded by inflation. 4, bonds. These are certificates of indebtedness issued by both governments and corporations, which are in urgent need of funds for their project. The interest earnings bond are fixed. The bonds sold by a central bank pay high interest, which makes them attractive to investor. However, such bonds involve large amount of money, which naturally excluded the poor from such kinds of investment. Number 5, money market placement. The money market refers to the buy and sell of short-term funds through a financial intermediary like a commercial bank and other financial institution. The price of such funds is determined by the free interaction between demand and supply. If there is a great demand for funds and supply is scarce, then the price is high. Price refers to interest rates, while short-term funds are highly liquid. Virtually riskless assets like promissory notes of prime corporation and treasury bills of the central bank. The buyers are the investors. Number 6, houses, apartments, and building ownership. Some wealthy individuals put their money in these kinds of assets or properties. Such investments appear very profitable considering the high cost of rentals. In fact, the value of townhouses greatly appreciate in just 1 year time. Fire and earthquake pose as hazard for such investment. However, insurance can minimize risk. Number 7, land ownership. Industrial, agricultural, and residential lands are good investment. Real estate prices keep on rising. Even in the remote provinces, the prices of land are already beyond the reach of the poor. In Metro Manila and suburb subdivision, lots have tremendously increased in their value. Real estate investment is a good protection against inflation. In urban center in Japan, only those with millions of pesos can purchase a small piece of land. 8, business ownership. For the poor, investment may be in simple business project such as sari-sari store, poultry, piggery project, handicraft business, or eatery. Business. All of these are motivated by profits. Of course, risks are present, but opportunity for higher incomes are great success. Naturally depends on good management. Number 9, education and training. The most poor families, the education of their children constitutes a good fortune. It is their passport to better economic life. In fact, not a few extremely poor individuals became rich and famous through university education. One of them is Diosdado Macapagal of Pampanga. He became president of the Philippines. Evidently, individuals with higher education and generally receive higher incomes. Number 10, foreign and exchange investment. These are those who are engaged in foreign exchange business called foreign exchange dealer or money changers. They buy and sell US dollars and in the process makes profits. For example, they buy $1 for 26.30 pesos and sell the dollars at 26 pesos and 40 centavos. So the profit of 10 centavos a dollar. 11. Precious tangibles. These refers to gold and silver coins, jewelries, old paintings, rare books, and others antiques like tools, guns, and other items. The value of these tangibles depends on their popularity and scarcity. There are individuals who made millions of money in these kinds of investment, and yet their invested capital amounted only to a few hundred pesos. Planning personal investment. Every individual investor should have a clear and definite objective. Some want family security, others aspire for more economic fortune. Thus, they engage in more profitable venture which require a huge funding. In the same manner, financial institutions have to choose investments that are appropriate to their particular needs. Like individual investors, they have to consider investments that are safe and free from market price fluctuation. Also, financial institutions like banks should deal with investments that are easy to market. Bank depositor may at any time demand from their deposit. Banks should be able to meet such demand without delay. Otherwise, public trust in the banking system would fall, and this is not good for the whole economy. Here are 3 priorities which are helpful in the choice of suitable personal investment. Number 1, life insurance. The most Filipino families' economic security and stability primarily depends on the earnings powers of the breadwinner. If he gets sick, becomes disabled, or dies, the livelihoods of the whole family suffer. For this reason, life insurance for the breadwinner is necessary to give economic security to the dependents. Number 2, readily available funds. These are assets which are always available to meet emergency. A bank saving deposit is a very good example, especially through the express teller. Money can be withdrawn at many times. Other assets can also be easily converted into cash. Investment for personal needs. These pertain to the satisfaction of personal or basic needs. For example, house and lot provide personal satisfaction to the owner. At least he is saved from the high cost of rental. Through the installment plan, many have been able to become homeowners. Futures of goods investment. Number 1, safety of the value of investment. When there is inflation, the value of an asset falls unless the percentage increase in the price of the asset is greater than the inflation rate. For example, the value of the property in 1980 was 20,000 pesos. If inflation rate increased by 50%, then the value of the property has also decreased by 50%. Number 2, saleable investment. Investor need cash to meet emergency as well as to take advantage of better business opportunity. If he can easily sell investment without any loss in value, then he has no worry about emergency or unexpected financial needs. And in case there is an emergency of better investment opportunities, he can easily dispose his investment and grab to the new investment opportunity. Thus, he gets more profit. 3. Stability of income. They are assets whose earning power is stable or fixed, such as bank, deposit, and bonds. Also, rentals of apartments and buildings are fixed, usually within a year time, and such rental increase every year to the disadvantage of renters. For taxes, one of the factors influencing the level of investment is tax rate. If tax rate is high, it discourages investment. Hence, some government even offer tax exemption to both domestic and foreign investor just to stimulate more investment. For instance, our own government provides tax incentives to cooperative and cottage industry in order to promote their growth. Investment banking. One way for corporation or government institution needing funds is to sell new securities. A corporation may sell stock and bonds. In the case of the government, it sells bonds. Such securities may be marketed through banks and other financial institutions. In the case of banks, the selling of securities of corporation and government agency is known as investment banking. This is done through the underwriting or agency marketing. As an underwriter, the bank buys the security at a stipulated price and sells this to investor. The bank gets profit or losses for such service. The price usually varies the quality or popularity of the securities. For example, X corporation issue bonds worth 50 pesos million. Y Bank buys the bonds at 49.50 million pesos. If Y Bank cannot sell the bond at 50 million, it bears the loss rather than X corporation. In the case of agency marketing, the bank does not buy and sell the security. It merely acts as marketing agent of the corporation which offer the new security. The bank gets a fee commission for its marketing service. It is paid for the number of security it can sell in the name of the corporation. Central Bank of the Philippines also buys and sells government security. If there is an excess money supply, the central bank sells its bonds. On the other hand, if there is shortage money supply or if government agency needs funds for their projects, the central banks buy their bonds. This is like lending money to government agency. Financial markets. In economics, the concept of a market does not necessarily refer to a fixed place or location like the Divisoria market or central market. There is a market whenever buyers and sellers agree to exchange regardless of their location and how they transact their mutual interest. There are two types of financial transaction: loan transaction and investment transaction. The former requires face-to-face negotiation between borrowers and lenders. The other ones involve the sales of financial instrument on an impersonal basis to any buyer. Such instrumented on an over-the-counter basis through dealers or brokers. Some are traded on organized exchange like the Manila Stock Exchange constitute the financial market in the narrow sense. The principal financial institutions of financial markets are the investment houses who acts as middlemen, dealers, brokers, or underwriters between buyers and sellers. Financial transaction, a financial market is classified on the basis of maturity, capital market, and money market. Capital markets refers to the buying and selling of long-term financial instruments like bonds and stock. Money market is concerned with the buying and selling of short-term financial instruments such as treasuries, bankers, acceptances, and commercial paper, short-term promissory notes issued by the finance companies and some others corporation. Money market. Money market is not a market for money. Rather, money is the financial world refers to a short-term, highly liquid, virtually riskless asset. It is the demand for the supply of short-term financings. The primary function of a money market is to match those units, corporation, banks, and other financial intermediaries with a temporary surplus of money with those with temporary shortage of money. Those with temporary surplus can place their money at a competitive rate of interest in the money market and feel secure because their money can be recalled on their very short notice if needed. In the same manner, corporation, banks, and other financial intermediaries that have term temporary shortage of cash can obtain money on short notice and short periods of time by borrowing in the money market. Through the money market operation, corporations and financial intermediaries are able to manage their financial affairs more efficiently and economize their money holdings. Idle funds can be used by those who need them for the business or production. Likewise, the central bank can use the money market system in its role of the regulating the money supply to foster economic stability and growth. For instance, the central bank can sell treasury bills and other short-term government securities to remove excess liquidity cash in the financial system. On the other hand, it can purchase money market instrument in order to infuse more cash into the economy when needed. Participants in the money market are the central bank, commercial banks, finance companies, dealers, and brokers. Money market in the Philippines, the introduction by the central banks of the treasury bills markets and the consequent organization of the National Associations of Government Security Dealers NAGSD in 1966 marked the formal beginning of money market in the Philippines. However, in 1965, an investment bank, together with 43 companies, organized the first intercompany submarket in the country. The investment bank acted as intermediary with the use of its own borrowing and lending notes and matched the long cash position of one company without revealing the identities of the companies involved. The money market is a market of short-term funds. These are bought and sold through an intermediary like commercial banks or other financial institution. The price of such funds is determined by the law of supplies and demand. If demand for funds is greater than supply and if demand fund is greater than supply of funds, the price increases. If it's a supply which is greater than the price decreases. Price refers to the interest of the short-term funds such as treasury bills or commercial papers which can be bought from the security departments of financial institutions. There are three principal participants in the money market: the seller, borrower, or issuer of short-term financial instruments, the buyer or lender, and the dealer or broker who acts as an intermediary. Nevertheless, if the dealer is the issuer himself, then there are only two participants. There are no requirements for buyer or short-term financial instrument except for a minimum of 50,000 placement. In the case of seller, financial instrument must be utmost liquidity and safety. Thus, only prime companies with reputable credit standing and the government are given access to the money market facilities. Money market instrument. Number one, listen to this. To all my friends and viewers and small YouTuber. Number one, government security. A, treasury bills issued by the central banks for national government in an effort to mop up excess liquidity on the map supply in the financial system. Maturities range from 35 to 365 days. Letter B, tax anticipation bill issued by the government for its various activities without waiting for tax payment days to come. These mature of income tax dates. Such bill are used for tax payment. C. DBP Progress Bond, long-term obligation of the DBP by banks part of their EPW and ED bonds issued specifically to fund public works projects, interest payable semi-annually. F. Central Bank Certificates of Indebtedness, CBCI, 3 years application of the Central Bank, interest payable semi-annually. Number 2, commercial papers. Letter A, prime corporate notes, unsecured negotiable obligation of prime companies to fund working capital requirement with specific maturities. B, banker acceptance time drafts drawn by a buyer or seller of good who arranges with the bank to accept such good as collateral. C, certificate of acceptance notes issued by the non-prime commercial firms, those whose credit is acceptable to bank but not yet to achieve investor buyers. The bank stamp its acceptance on the notes to make it acceptable to investor. Number 3, call money. Letter A, demands loans, mechanism used by banks to adjust their daily reserves positions, the amounts of reserves independent on total bank deposit. This changes every day since deposit is also changed. Bank with deficient reserve requirements have to borrow from banks with surplus reserve. In essence, this interbank call market is in the central bank deposits which are left and borrowed mainly overnight by commercial banks at a specified interest rate. Such banks are required by the central bank to put up percentage of their total deposit as reserve. These are the form of cash in vault, CB supported securities, and deposit with the central bank. Letter B, terms loan, loans to banks for definite periods of time. Types of transaction. Number 1, straight sales. It involves a direct sales to an investor of money market instrument up to maturity date. For example, the dealer bought 50,000 pesos Meralco note on January 1, 1992 to mature on May 31, 1992 with 32% interest per annum. Supposing on April 16, a client went to the dealer bank and said he had access money up to May 31, the dealer sold the Meralco note to the client up to May 31 at 30% per annum for 45 days. On the date maturity, the client receives 50,000 plus to corresponding interest earning. The bank acted as intermediary between Meralco and the client investor. The bank earned 2%. In case the denomination of the notes are in 100,000 pieces, the dealer sells to their client who can only afford 50,000 investment. The notes in trust, these are common occurrences in the money markets or operation. 2. Repurchase agreement. An investor in many instances may desire to invest in money market security for a number of days like 30, 590, etc. It's often happen that the dealer that have the security which coincide with such maturity, the solve this problem, the dealer execute or repurchase agreement with the investor on the date of maturity chosen by the investor. For example, in the case of government security with medium and long-term maturities, the dealers can sell this as short-term instruments, say 90 or 180 days maturity. Now, let's go to the questions of money, credit, and banking introduction to investment. No? Number 1, define investment. Different it from speculation and gambling? 2. What are the types of risk? Explain 1. 3. What are the classes of investment? Which do you prefer? Explain your preference. Number 4. Outline and explain your personal plan for investment. 5. What are the features of good investment? Explain 1. 6. Explain the investment banking. 7. Define financial market, capital markets, and money market. Who are the principal participants in the money market? Number 9. Give example of money market instrument. And lastly, number 10. Explain one type of money market transaction. This is the end of my topic, Introduction to Investment, Money, Credit, and Banking. Introduction to Investment. Now, let's proceed to the next topic, the role of IMF in international finance. The International Monetary Fund, IMF, together with the International Bank for Reconstruction and Development, IBRD, now the known as World Bank, was a creation of the Bretton Woods Conference in 1944 at New Hampshire, USA. A group of 44 allied nations participated in the conference to formulate a global monetary system in order to facilitate the growth of international trade as one of the major goals. The twin organization WB-IMF opened their doors for business on June 25, 1946. All the participants except the Soviet Union became members. Other communist countries like Cuba, Poland, and Czechoslovakia ceased to be a member of the WIMF. The Philippines is one of the original members. At present, there are 164 members countries. The principal task of the IMF is to extend short-term loans to countries with balance of payments problems. Balance of payment is the summary of all financial transactions between one country and other countries for many years. For countries been experiencing deficit balance of payment. This means their outflow foreign exchange is greater than their inflow of said financial resources. Obviously, a country without foreign exchange like the US dollar cannot import materials for its factories like what happened in the Philippines in 1984. However, the granting of IMF International Monetary Fund loans require compliance with specific IMF conditions such as devaluation of the local currency, elimination of import restrictions by the borrowing country, and financial reforms. Among other things, because of this, the IMF has been the focus of bitter attacks by many third world countries. It has been accused as a tool of US economic imperialism and an economic exploiter. Others accuse it as a foreign institution which is interferer with the political and economic affairs of the poor countries. A similar critical observation of the third world countries is about the effectiveness of the IMF in meeting the problems of the present international economic order. The claim that the global monetary system designed by the Bretton Woods Conference in 1944 does not suit anymore the present existing economic condition. Some financial specialists from the rich country even propose the transformation of the IMF into a world central bank. This chapter provides a basic general information of the IMF organizational structure, conditionality, quotas, special drawings right, and the various credit facilities available for the poor countries. In addition, the proposed new international monetary system is discussed. All right. Organizational structure. The highest authority of the International Monetary Fund is the Board of Governors. Each member country is represented by the government and alternate governor in the most cases. The IMF governors are Minister of Finance or central bank governors in their countries. The Board of Governors has delegated many of its power to the Executive Board, which is responsible for conducting the business of the IMF. The governors usually meet once a year to decide on important issues such as the admission of the new member, adjustments of quotas, election of directors, and other vital matters. The Executive Board is in permanent session of the fund's headquarters in Washington, is regularly deals with wide variety administrative and policy matter, issue annual reports to the Board of Governors, conducts discussion to complete the process of consultation with members, and from time to time produces comprehensive study on crucial issue of particular relevance to the international financial aspect of the IMF members. There are now 22 executive directors, 6 appointed by the biggest stockholders of IMF, namely the United States, the United Kingdom, the Federal Republic of Germany, constituencies representing the remaining IMF members. Each of the major stockholders can appoint one executive director. The managing director is the chief of the IMF staff and chairman of the executive board. Next to him is the deputy managing director. The managing director has always been tradition a European who is acceptable to the United States. However, the duty of managing director is an American. In the case of the World Bank, its president is always an American. The United States has the largest shares of stock in both W and IMF. It controls about 20% of the capital stock and said international financial institution. Voting power of each member country is number of shares of stock. The Philippines has 0.49% of the total quotas shares, and its voting power is 0.5% of vote. IMF objectives. Number 1, to promote international cooperation through permanent institution which provide the machinery for consultation and collaboration regarding international monetary problems. Number 2, to facilitate the extension of balanced growth of international trade and to contribute the promotion of high levels of sustained employment, production, and income among the members' countries. 3, to promote exchange stability, to maintain orderly exchange arrangement among members' country, and to avoid competitive exchange, the depression. 4, to assist the establishment of multilateral system of payment on current transaction between members' countries and elimination of foreign exchange restriction which hamper to growth of international trade. 5, to provide confidence the member of countries with a balance of payments problems by extending various credit facilities to them. Such loan enabled the member countries the opportunity to correct maladjustment in their balance of payments without resorting the measures which are not favorable to national or international prosperity. 6, the shorten the duration of reduce the degree of disequilibrium in the international balance of payments of member countries. Quotas of IMF members. Every IMF member is required to subscribe to the IMF an amount equal to its quota. It has to pay in gold US dollar 25% of its quota. The remainder is paid in the member's own currency. It is a peso in the case of the Philippines. The quota of a member country is based on its economic strength. For each country applying, the IMF members appropriate data are gathered on the economy and calculate quota range is determined. The relevant data are then compared with those existing members of comparable economic size, and appropriate quota is determined. The executive board evaluates the recommended quota and the assets in which the subscription is to be paid. If result and favorable, the application for membership is forwarded to the Board of Governors for approvals. Once approved, the country signs the articles of agreement and becomes a member. Quotas of a member countries, which at present is approximately SDR 89.2 billion, are closely related to number 1, their subscription to the fund, number 2, their drawing rights on the fund, 3, their voting power, and 4, their share of allocation of SDRs. The voting power of a member is determined by 150 basic votes plus 1 vote for each SDR 100,000 of quota. SDR means special drawing rights. An international paper goals valuation is determined on the basis of a basket of 5 currency: US dollar, Jutski mark, French franc, Japanese yen, and the pound sterling. SDR is equivalent to US dollar $1.42. Reviews of quotas of IMF members are held at intervals of not more than 5 years to determine whether quotas should be increased to take into account the growth of the world economy and changes in relative economic position among members countries. The latest increase of quota was approved at the end of March 1983. As stated earlier, the less developed countries have been experienced deficits of payment. This problem have been caused by factors like the few traditional exports and their limited entry into the world markets, and their prices are the mercy of the rich country. More of these are discussed in the next chapter. As a result, their export earnings are lesser than their import expenditure. Such economic condition immediately drains their inadequate international research. The IMF stands ready to provide short-term financial assistance to this country who have been suffering from the balance of payments difficulty. The normal IMF facilities are: number 1, ordinary drawing rights. These rights are composed of those element golds, tranche, and credit tranche, and the tranche is divided to 4 equal subtract. On the first credit tranche, if IMF policy is usually liberal, it only requires the borrowing members country to make a reasonable effort to solve its problem. However, for the higher credit tranches, the funds requires a substantial justification for the loan's application. The criterion for such loan is quite exacting and requires the borrower to present especially convincing demonstration of the adequacy of the policy of his pursuing or intending to pursue the funds. Requires the borrower to adopt the policy that gives substantial assurance that is the balance of payment difficulty will be resolved within the reasonable period. Number 2, standby arrangement. Since 1952, ordinary drawings of the funds IMF have been conventionally made on standby arrangement. This guarantee a borrowing members country an assured line of credit for a certain period of time, usually 1 year. The assured credit is higher than the gold tranche drawing and renewable based on the consultation with the IMF mission of the borrowing members of country. Submit a letter of intent which sets out of the objectives of its economic program and in the policy it intends to pursue in order to attain such objectives in that intention meets the condition of the credit tranches. The borrower is assured by the standby arrangement that will be able to make the purchases of foreign currency in a specific absolute amount during the life of the arrangement. By the way, a member country can purchase of the currencies which it needs with its own currency. For instance, the Philippines needs the US dollar. It can purchase such foreign currency with the Philippine peso, and it will buy back its peso for the at later date, normally within 3 years, with foreign currency which is acceptable to IMF. The standby arrangement guarantees that the first credit tranche will be available in full and which will not consider the actual economic performance of the members country. However, in the case of a higher credit tranches, second, third, and fourth tranches, there will be availability depends on the observance of performance criteria. This refers the policy formulated in the letter of intent and quantify and objective terms which are vital to the success of the program presented by the members country to the IMF. The members' rights to draw is always subject to the observance of certain performance criteria described in the program or to the further review of the situation. The performance criteria often cover credit policy, government financing, and policy on trade and payments restriction. They may also extend to the contracting or using short-term, medium-term foreign debt and exchange in external reserve. Such performance criteria permit both the member country and the IMF to evaluate progress in the implementation of policy. During the stand-up arrangement, any failure to observe the performance criteria prevents purchase of foreign currency from the IMF. Both members country and the IMF examine whether further measures are necessary to attain the objectives of the program. Especially drawing rights. The SDR is international reserve assets created by the IMF. It is allocated to its members as a supplement to existing reserve asset. The IMF has also allocated a total of SDR 21.4 billion in six allocation. SDR are allocated to the members of proportion to their quotas at the time of allocation. Such allocations take into account the global need to supplement existing reserve assets. The last allocation of SDR was allocated to 141 countries that were members of IMF. At the time, during the annual WIMF conference held in Seoul, South Korea in 1985. The less developed member countries demanded for a new allocation of SDR in order to enlarge world liquidity. At present, there are 151 members countries. SDR are primarily designed to meet balance of payments needs of member countries. They were first introduced in 1970 by the IMF to provide the international monetary system with method of creating liquidity. Such SDR can be exchanged with foreign currency like US dollar. Members may also use SDR in transaction and operation among themselves since the SDR is the unit of account of IMF. The value of the SDR is estimated daily by the IMF as the sum of value in US dollar based on market exchange rates of a specified amount of the markets of 5 currency. These amounts are derived from agreed percentage weights for the currency in the market using average exchange rate for the 3 months ended December 31, 1980. The agreed weights are 42% for the US dollar, 19% for the Juski mark, and 13% for the French franc, the Japanese yen, and the pound sterling. Such weights reflect the importance of the currency in international trade payments based on the value countries. IMF special facilities. Aside from the tranche policy of the funds, there are other financial resources which member may draw on. These are the special facilities of the IMF which have been designed to assist member countries with balance of payments problem. One of these in the extended funds facility which is intended to meet the balance of payments need. In addition, there are 2 payments facility for a specific purpose, facility for compensatory financing of export and the buffer stock financing facility. Also, member countries may sometimes avail themselves of temporary facilities set up by the fund. For instance, during the sharp increase in oil prices, funds provided assistance under temporary oil facilities designed to assist members meet the increased cost of imports of petroleum and petroleum products. In 1981, a policy of enlarged access of the fund's resources was adopted. Here are the details of the special facilities of the fund. Extended funds facility. Under this facility, the fund may extend financial assistance to members countries to be able to meet their balance of payments deficit. Such financial assistance has a longer period and bigger amount than the assistance given under the credit tranche policies. In applying for extended arrangement, a member is expected to present a program specifying the objectives and policy for the whole period of the extended arrangement. Purchase for foreign currency are paid and made subject to the performance clauses relative to the implementation of key policy measures in attaining the objectives of the program. Members countries are eligible for the use of these facilities if they have serious balance of the payments deficits relating the structural maladjustment in production, trade, and price. Next, compensatory financing facility. This has been designed to provide financial support to the member countries that are suffering from balance of payments problem caused by temporary shortfalls in their export earnings. These are the agricultural countries that depends mainly on the export of raw materials and few crops for their export earning. Such member countries may draw on the funds to compensate said shortfalls. In the fund is satisfied that the shortfall is temporary and is largely due to circumstances beyond the control of the member country, and if their member country will cooperate with the fund in solving its balance of payments problems, then the members can get such financial support. Next, buffer stock financing facility. This is help in the financing of members' contributions to the international buffer stock of primary products like rice, sugar, tobacco, or corn. This is done when members are experiencing balance of payments difficulties. Another condition is that the member is willing to cooperate with the fund in solving its balance of payments problem. The fund has authorized the use of its resources in connection with tin, cocoa, rubber, and sugar, but drawings on said facility have been made only with respect to tin, rubber, and sugar. Next, enlarged access policy. The objective of this policy is to enable the funds to provide supplementary financing to all members facing serious balance of payments deficit. All members facing serious balance of payments deficit. This is used only in support of the economic programs under the standby arrangement reaching into the upper credit tranches or under extended arrangement. Drawing on these supplementary finances are subject to the policy of the fund, including those on conditionality, pacing, and performance criteria. IMF conditionally. IMF means International Monetary Fund. So the financial resources of the International Monetary Fund are in revolving pools of funds. These are made available on a temporary basis to member countries facing balance of payments difficulties. A member country who apply for the use of such resources is generally required to carry out an economic policy program aimed at attaining a viable balance of payment position over the appropriate period of time. This requirement is known as conditionality In our experience, in our own experience, the funds required the previous government to devalue our peso to reduce excess liquidity, to increase sales taxes on certain products, to reduce government spending, among others. These have been some of the IMF condition imposed of the government for the release of IMF loans to the Philippines. A viable payments position means, especially for the many less developed countries, a current account of devices that can be sustained capital inflow on terms compatible with the development prospect of the country. Such solutions to balance of payments problem does not resort to restriction on trade payment, which only aggravate the existing distortion rather than correct them. Such corrective strategy provides for reorientation of the economy towards sustained growth. This avoid purely deflationary policy that have a deleterious effects on investment and fail to stimulate the required shift of resources to the external sector. Flexible approach. Conditionality must adapted to changing circumstances and specific cases. It should not be a rigid and inflexible set of operational rules. IMF executive directors have on many occasions reviewed and amended the policy of practices on the conditional uses of financial resources of the IMF. A general review was undertaken in 1968, and since then there have been periodic discussion of particular aspect of conditionality when new credit facility have been introduced. A second comprehensive review of conditionality was made in 1979. Asset guidelines has been formulated for borrowing members countries to follow. Number 1, emphasis on the need to encourage members to adopt corrective measures at an early stage of their balance of payments difficulties. 2, recognition that many cases require periods of adjustments longer than those normally associated with standby arrangement. 3, adoption of flexible approach for the treatment of external borrowing in adjustment program. 3, for stress on the necessity to pay due regard to the domestic, social, and political objectives, that economic priorities and the circumstances of members, including the causes of their balance of payments problem, and adequate coordination of policy relating to the use of the IMF resources to ensure uniformity of the treatment of members. Basis for conditionality. Basically, the role of IMF is to help alleviate the balance of payments difficulties of a member countries, and conditionality is an essential element in such role. It seeks to ensure that the members' policy are adequate to achieve a viable balance of payment position over a reasonable period of time. Also, it means ensuring the maintenance of resolving the nature of the IMF financial resources. National, it's neither desirable nor feasible to finance balance of payment deficit over a protracted period without reducing or eliminating the principal causes. If balance of payments is difficult or merely suppressed by resorting to restriction or merely finance, such problems are likely to reappear after a period of time, perhaps in a more acute form. The fundamental question of whether adjustment is required depends on the nature of the balance of payments problem in the balance. If the imbalance is temporary and self-reversing in a reasonable period of time, adequate IMF financing is able that is required. However, it is the imbalance is not caused by the transient and self-reversing factor, then corrective measures are required, including financing. Conditionality in price. The IMF uses pragmatic approach in assisting countries formulated adjustment program. Considering the diversity of the IMF members' condition, it would be impossible to rely rigidly on any model of adjustment to be applied across the board to all IMF members. Rigid use of a uniform model would be inconsistent with the need to apply IMF policy in a non-discriminatory manner. IMF programs are designed jointly with the members country. A program involves a true review of the members' economy together with the cause of nature of imbalance of payment problem. Also included is an analysis of the most appropriate policy within its institutional framework for attaining a sustainable balance between demand for and the ability of sources. The impact of fund-supported programs on the other economic variables like income distribution, employment, and social services depends on the manner in which the relevant policy are implemented. Decision on the detailed execution of policy measures are naturally the sole responsibility of the government of the member country. The IMF refrain from involving itself directly in microeconomic policy measures that are closely related to a country's social policy choices. Such direct involved money would be a variance with conditionality guidelines. LDC demand for growth and liquidity. The less developed countries' LDC demands top priority for growth and liquidity. During the IMF conference in Seoul, South Korea in 1985. During the IMF conference in Seoul, Korea in 1985, the less developed countries opposed the IMF conditionality being imposed on the less developed countries. The requirement of the IMF on the heavily indebted countries is for them to sustain economic stability, but the goal of stability has been elusive and even receding. Thus, the less developed countries have presented the better IMF medicine. Dr. Dragoslav Abromovic, a distinguished economist from Yugoslavia, said that without economic growth, and that means to secure it, there is no viable solutions to the debt crisis. He further pointed out the IMF should be make development rather than austerity a major objective in working out the condition of which is assist the LDC facing the balance of payments difficulty. He said further that IMF should attach the highest importance to a new allocation of SDR to ensure the world liquidity commensurate with the value of world trade, financial transaction, and production. The demands of the less developed countries are economic growth, liquidity, and soft loans, low interest rates. On the other hand, the International Monetary Fund is prepared to provide adequate financial support to countries seeking additional credit that are willing to adopt the unusual IMF appropriate policies such as devaluation, money credit banking, free trade, expansion, foreign investment, increased taxes, political reforms. That is the IMF appropriate policies such as devaluation, free trade, expansion of foreign investment, increase of taxes, and political reforms. New international monetary system. The less developed countries have clamored for a new international monetary system. It would be a monetary system that could reflect the development needs of people living in different economic conditions, social system and culture environment. Such call for a new international monetary system was formally made at the North-South Conference of the North International Monetary System in the new international order held in Tanzania, Africa in 1980. Participants from the less developed countries claim the existing international monetary system devised of Bretton Woods in 1940 reflected only conditions at the particular period. At the time, the United States dominated the capitalist world and there were colonial empires. The third world as we know them today were not yet in existence. The present international monetary system, also known as the Bretton Woods monetary system, favor only the new industrial countries like the United States, Japan, France, United Kingdom, and West Germany, and their multinational corporations. The main objectives of the World Bank and the Fund is the expansion of international trade and foreign investment without restrictions such as economic growth is based on the law of comparative advantage, which promotes specialization in productions of goods in very country. Member countries that are not receptive to such objectives are not granted liberal and adequate IMF credit facilities. Obviously, the less developed countries cannot compete with the industrial countries in free world market. If they follow the operation of free trade based on a comparative advantage, their permanent role is to supply raw materials to the industry and the industrial countries and imports of finished products. Such a relationship with existing today is a great disadvantage to the poor countries. In fact, this is the major reason why such countries have been experiencing balance of payments difficulties, and yet the IMF basic function is to help members countries in their balance of payments problem. For this and another reason, the third world countries have consistently questioned the adequacy of legitimacy of the monetary rules and mechanism that were formulated in 1944. They claim that this had been made with very little participation from them. They believe that this is impossible to implement the genuine international development strategy without fundamental changes of the international monetary system, hence the need for the construction of a new international monetary system to be participated in the international community. Objectives of a new international monetary system. A new international monetary system must serve the following fundamental objectives. It must be capable of Number one, it must be capable of letter A, achieving monetary stability, letter B, restoring acceptable levels of employment and sustainable growth, and letter C, check the present strong inflationary tendency in the world economic. 2. It must be supportive of global development, especially for the third world countries where most of the world's poor live. Characteristic of a new international monetary system. The principal characteristics of a new international monetary system must be, number one, democratic management and control. This enables interests of the majority of the world to be clearly and adequately reflected. Nevertheless, a significant influence may be wielded by the big industrial countries. 2. Universality, since trade and payments have increasingly become international, global, interdependent demands that all nations should be participate in the institutional arrangement for the management of the international monetary system. 3. Establishment of international money. This is act as a global medium of exchange and primary reserve asset that international community cannot be afford situation where only one country requires its own money as the international means of exchange. 4. Organization of a new international monetary authority. It accommodates the needs of the various development program and a socio-economic system. It controls the supply of international money and be able to redistribute national payment surpluses and existing reserve. It requires firm rules and mechanisms governing the creation of international currency based on world production and trade and its distribution based on balance of payments need. World Central Bank. It has been strongly suggested that the IMF should be gradually transformed into World Central Bank. This is similar with the process of a central bank of a country. It is provides a uniform and universally acceptable currency with stable value. It exercises systematic control of the total supply of currency reserve. It regulates balance of the payments position of members' country. Also, it acts a lender of a last resort. The proposed World Central Bank would be constitute IMF members. It is not necessary to change the voting powers of the members, which are based on their quotas, and international money would be created to be used as a reserve currency and as means for settlement of imbalances of payment among central banks and member countries. Such international money could be used as private transaction currency. The value of said international money would be equal to the basket of a certain specified currency. Some suggests that the SDR could be international money for the proposed World Central Bank. British economist John Maynard Keynes, one of the founders of the World Bank and the IMF, proposed the creation of the World Central Bank during the 1940s. Such concept of World Central Bank is likely to encounter several problems. Nations may fear the loss of sovereignty over their own monetary affairs. There would be conflict in the formulation of a most desirable monetary policy. Moreover, the divergence of interest among countries may restrict policy making. However, there are the indication the natural resistance to the concept of a world central bank can be hurdled. When the IMF was founded, many doubted its survival in so with the establishment of the European monetary system, but these two institutions are now viable. Evidently, the strongest argument in favor of the creation of a world central bank is that no alternative has so far worked well. IMF criticized. IMF criticized President Alan Garcia of Peru stated that the IMF is an imperialist agency that hinders the world development. He said the IMF delegates will not allow in Peru and repeated that the nation will not listen to IMF economy recommendation. Peru had $14 billion foreign debt and it could not pay the $70 million in overdue interest. President Garcia intended only to use 10% of his country export earnings for his foreign debt payment, but the IMF did not agree and warned that it could declare Peru ineligible for the new IMF loan, including those coming from the World Bank. It is noted that our country is also about 26 billion foreign debt led by the Marcos regime. Our country is religiously follow the IMF conditionally. Additionally, loans have been scheduled for release depending on the performance criteria set by the IMF. On the other hand, same Filipino nationalists and other the third world have accused the IMF together with the World Bank as the tool economic military interests of the United States. The IMF policy of free trade and foreign investment stimulated for the growth of multinational corporations owned by the United States and other industrial countries. These countries are the biggest stockholders of the bank and the IMF. The borrower in the lender's slave. A former top United Nations official who was once a classroom teacher in Burma said there are no permanent friends. Do you agree to all my friends and viewers? The teacher said in Burma, there are no permanent friends. Are you agree? Well, for me, this will depends, but I believe there's a permanent friends. They are. Only permanent interests remain. The IMF and the World Bank and neither civic organization are engaged philanthropy. Whenever the biggest stockholders of the World Bank and the IMF think on their own business interests, they merely follow the law of human nature. Not a few poor countries complain in the high interest rate of foreign loans. They also dislike interference of foreign lenders. particularly the World Bank and IMF, to avoid such problem. They should minimize their foreign borrowings. The policy of the IMF of the World Bank is to impose higher interest rates and more rigid policy measures of nations with large foreign debts. The Marcos government appeared to be the favorite customer of the World Bank and the Asian development because it was receptive to the entry of multinational corporations and due to the presence of US military bases in the country. In the case of the Aquino government, it's intent to rely on more local capital investment for the development of the country. It has encouraged, nonetheless, on the present government foreign loans is not accept those without a string attached. These are loans without political and economic condition being imposed on the borrower relevant to the plight of many less developed countries. In the message of King Solomon, the wisest man of the biblical times, Proverbs 22:7, poor people are the rich man's slave. Borrow money and you are the lender's slave. Now, this is the end of my topic, money, credit, and banking. My topic, the role of IMF in international finance. And now, let's go to the question for review and discussion. You can bring your paper or notebook, also your ball pen. And this is 10 question about the role of IMF in international finance. Question for review and discussion. Number 1, explain briefly the organizational setup of the IMF. 2, explain one objective of IMF. 3, define SDR. 4, explain one facilities of IMF. 5, what is the letter of intent? 6, explain the performance criteria. 7, explain the reaction of the third world members toward the IMF conditionality. 8, explain one characteristic of the proposed new international monetary system. 9, what are your views of the proposed world central bank? Borrowers are the slaves of the lenders, and why? That is the 10 questions about the role of IMF in international finance. Now, I will end this topic. Maybe in this evening, or maybe evening or tomorrow, I will discuss about money, credit, banking. My topic is all about exchange rate policy of the LDC. All right. So this is the end of my live stream. Before anything else, I would like to say to watch all my video. Don't forget to subscribe. Don't forget to like. Don't forget to comment and answer all the questions in my topic. And lastly, click all bell. These are the most important, and God bless you all and more blessing to come to all my friends and YouTuber. I love you all. God bless you. Bye-bye.